Let's do a bit more on this. I'm joined now from Hong Kong by Ken Courtis, investment banker, global economist and founding partner of Themes Investment Management. Ken, welcome to the programme.
Thank you, Tiki.
Well, we're often talking about this question of a hard landing or a soft landing with China and how difficult it is to engineer. But the largest trade deficit since 1989, how significant is that?
Well, it is significant. It's not so significant in that it reflects a slowing of the Chinese economy because imports are surging. So the Chinese domestic consumer is buying more imports today than ever. In fact, that's been the great untold story of China the last 3 years. It's the surge of imports. What it reflects on the export side, of course, is very slow growth in Europe and slower growth in America, and so Chinese exports have fallen off. Tiki, I'm not so worried about a hard landing. I know people are either think China's going to paradise or it's going to hell. I have sort of a in-between view that they will muddle through, that this slowing we're seeing in the Chinese economy from 11% in 2010 to 9.2 last year to something around 8%, 7.5 this year, is really a policy-driven slowdown as they're trying to squeeze the excesses out of consumer prices, and they're trying to put a lid to some extent on real estate in the major cities. And I think that the numbers we're seeing now on growth, on the export side, across the economy on inflation, means that the central bank will be easing quite a bit as we move through the next 2 quarters, and I see China bottoming over the summer.
You don't think they've tipped it already a little too far? I noticed Premier Wen Jiabao earlier this month talked about a target GDP of 7.5% this year, and obviously keeping a lid on inflation is very important, but inflation numbers have come down quite considerably, haven't they?
They have. They've come down from 6.5%, and the recent number was 3.2%. The slightly higher oil prices, I mean slightly higher in Chinese currency terms, is going to put a little upward pressure on prices as we move ahead. And so as long as they can keep inflation under 4%, I think they're pretty happy in Beijing. Have they held this squeeze a little bit too long for some sectors? Clearly, but I think the view of the leadership at the top, anyway, in Beijing is that there's going to be some broken cutlery as we go through this. There's going to be some companies that'll get into trouble, and they're the ones that should be, in a sense, cleaned out of the economy as this purge continues. But I'm pretty confident, having talked to people last week during the party conferences in Beijing, that the most intense period of the squeeze is behind us, and from here the story will be the easing in China as we move through to the summer.
Yes, you talk about this easing, and this will be, I think, the third time in terms of the amounts of reserves that the banks will have to hold. How far can they go? Because, of course, elsewhere in the world, reserves for banks have been going up, haven't they?
Well, the reserve requirements, in a sense, that the Chinese are imposing are a slightly different concept than we have in Europe and America. And by the way, later this week we'll get the new stress test out about the U.S. banks to see what their basic capital is. But the Chinese reserve requirements have basically meant that the Chinese banks could lend less and less. And they've almost doubled those requirements in the last 2 years. And I think you'll see that cut back quite substantially in the months ahead. So there's going to be trouble. Some companies will go under. There will be broken dishes here and there, but I'm quite confident that China's going to pull this off.
Ken, one of the things you've been looking at is the amount of action that the central banks worldwide have been involved in over the last 2 or 3 months to deal in particular with Europe, I suppose. Just what sort of impact has that had on bond markets and equity markets?
Well, Tiki, you're right to underline that. There's been literally a tsunami of money thrown at the world economy. The European Central Bank has put on more than €1 billion, so $1.3 trillion, pardon me, onto the European banks. The U.S. Central Bank has committed to keeping interest rates at 0% through to the end of 2014. They've opened up this unlimited window, if you like, of lending dollars to European central banks and the Canadian Central Bank and the Bank of England, so they can then lend that money on, if required, to their banks. We've had the Bank of Japan substantially increase the liquidity it's injecting into its economy, not to talk about the interest rate cuts that have been occurring in other economies as we've moved forward. So we've probably never seen such a concentrated effort. And I think the consequences of it, Tiki, are pretty clear. Number one, it's taken the euro together with this Greek write-off that we've had over the last few days and the new financing from the European Union. It's taken the euro out of what I'd call an existential crisis back into the critical care ward. I think, secondly, it's given more confidence to this lift we're seeing in the U.S. economy, which is really positive. We've seen, the U.S. has created 750,000 new jobs in the last 3 months.
Yes, yes.
And thirdly, it's put a fire under equity markets and bond markets, and where markets are up 30% so far since the bottom last November, December. So all of that is the result of this tidal wave of money.
Ken Courtis, always good to talk to you. Thank you so much for joining us from Hong Kong.
Pleasure.